Hello everyone, my name is Shreya Kumari and today I will be presenting on the topic Bank-led microfinance institution and small finance banks exploring financial inclusion and services. Earlier, many microfinance institutions or MFIs were operating independently and mainly providing small loans to low income individuals. But over time, some of these banks led microfinance institutions transitioned into small finance banks, commonly known as SFBs. So this transition allowed them to expand their services beyond just lending. Now they can accept deposits or provide saving accounts, offer credit facilities, and deliver a full range of banking services to undeserved communities. So the main objective behind this transformation is to promote financial inclusion, ensuring that even low income and unbanked population can also have access to formal financial services. Now, coming to the next slide, to the introduction to microfinance banks. So, microfinance banks were introduced to deepen financial inclusion in India. Like previously, the microfinance institutions focused mainly on microloans. However, after becoming SFBs, they gained the ability to accept deposits from customers, providing savings and current accounts, offer fixed deposits, loans to small businesses and individuals, or support MSMEs and rural and entrepreneurship. So the transformation strengthened the financial ecosystem because customers no longer needed separate institutions for savings and borrowings. Everything could now be managed under one regulated banking structure. So essentially, the SFBs bridge the gap between the traditional banks and the undeserved communities. Now, next we will be talking about the legal framework. So, both bank-led microfinance institution and small finance banks operate under the Banking Regulations Act 1949. Now, they are strictly regulated and supervised by the RBI, that is Reserve Bank of India, which ensures the financial stability, customer protection, proper capital adequacy, and risk management. Since they are regulated banks, they must follow all RBI guidelines related to capital requirements, governance standards, and reporting norms. So, this regulatory banking increases public trust and also ensures transparency in their operations. Now, next is the government structure. Now, governance play a very vital role in the SFBs. First, let's talk about the board composition. So, SFBs must have a majority of independent directors. This ensures unbiased decision making and reduce conflicts in the interest. Now, second, the CEO appointment, which requires the RBI approval, and this ensures that leadership meets the fit and proper criteria set by the regulators. Now, third, the promoter influence is regulated. Now, promoters cannot have unlimited control, which strengthens the governance standards. Now, let us discuss the key committees. Like, first one is the audit committee, and the audit committee ensures accurate financial reporting, compliance with the regulations, and integrity of the financial statements. They maintain a very transparent and ensure that financial records are really reliable. Now, the second one is risk management committee. So this committee identifies and manages credit risk, operational risk, or market risk. So they ensures the bank operates within its risk appetite and maintains financial stability. Now, the second last one is nomination and remuneration committee. So this committee governs appointments, reviews compensation policies, and aligns remuneration with long-term goals. It ensures fair and performance-based compensation. Now, the last one is Asset Liability Management Committee, which is also known as ALCO, that manages liquidity risk, interest rate risk, and funding structure. This ensures that the bank maintain a very proper balance between the assets and the liabilities. So overall, the governance structure of SFBs is strong and well regulated. Now coming to the next slide, the key characteristics of SFBs. Now, small finance banks have several key characteristics. That is, strong regulatory compliance, high governance standards, focus on undeserved communities, ability to accept deposits, ability to provide loans. Unlike traditional MFIs and SFBs, they can mobilize deposits, which reduce the dependence on external borrowings. Now, this makes them more sustainable and financially stable. Now, role in financial inclusions. One of the most important role of financial small finance banks is promoting financial inclusion. In India, many individuals, especially in rural and semi-urban areas, do not have access to formal banking services. Now, SFBs help by providing microloans to small entrepreneurs, offering saving accounts to low-income households, support small business and MSMEs, encouraging financial literacy. Now, by doing this, they empower individuals to start business, save securely, access for formal credit, and improve their standard of living. So they contribute directly to economic growth and poverty reduction. Now, in conclusion, I'd like to say that the bank-led microfinance institution transitioning into small finance banks has been a significant step towards the strengthening India's financial inclusion framework. With very strong governance, RBI supervision, and a focus on undeserved population, SFBs are they are playing a very crucial, very vital role in expanding access to banking services. They combine the social objective of microfinance with the stability and structure of formal banking. Yeah, no, so thank you. That's it from my side.